Repossession in your credit report will cost you a fortune. Your interest rate will be astronomical and you'll pay probably double what someone else would pay for the same car. In the following video, I interview Kenneth Jarman. He's an auto financial specialist, and he's going to show you how to legally remove a repossession from your credit report. You will hear a section about how to fix my credit. That was a do-it-yourself credit course that we used to sell in the past. Now we're offering that information for free on our YouTube page under US Credit Advocate. So subscribe if you want more do-it-yourself credit tips. Enjoy. Welcome, everybody. My name is Brian Diaz. This is Auto Lending Revealed. I have my guest speaker on, Ken Jarman. Let's see. So, quick introduction myself. I'm the CEO of How to Fix My Credit, nationally recognized credit expert. I got a bunch of books on Amazon. Check them out. Just search Brian Diaz. I'm the creator of the credit audit system. I've been doing this a long time, and also U.S. Army vet. But more importantly, let's talk about my guest, because who cares about me? Ken, I met the acquaintance of Ken only a short time ago, maybe about a year or so.
Yeah.
But he quickly established himself as an expert in a certain industry that, as a credit repair owner, I can tell you, I can vouch that myself and other credit repair business owners have little knowledge in. So we all refer to Ken as the auto loan expert. Ken is the president of realcreditrepair.net. You check out his bio here. He grew up in Miami and in Latin America before moving to Texas in 1991. In 2005, he realized a lifelong dream and opened up his own car dealership and doing his own auto financing. So for 10 years, he was an active member of the Texas Independent Automobile Association, and he's got decades of experience in managing operations in automotive financial services. By the way, if it's not obvious, I'm Hispanic, I drink a lot of coffee, and I live in New York. So if I talk crazy fast, there'll be a replay. You can slow it down. In 2015, Ken sold his automotive company and he became a consumer and business consultant, meaning consumer and business credit consultant. He's I can vouch for this. He's very passionate about educating consumers about the whole auto lending industry, and he's a co-founder of Turbo Business Suite in San Antonio. So Ken, first of all, thank you so much for joining us today.
Hey, thank you for having me. I'm happy to be here. Sure. Awesome.
Is there anything you want to add to that about your history?
Well, no, I mean, I'm a rare bird because I didn't spend all my time in either debt servicing or retail sales at car dealerships. I split my time in both. So I kind of started with my dad, who had a car dealership and a finance company, and then he exclusively just had the finance company. So I worked at 16. I got a funny story about that. He woke me up at 3 o'clock in the morning when I was 16, right after I got my driver's license, and he got me to go repo a car with him. He made me go with him to get this car. And the funny part about that story is that we couldn't get the car because there were 2 Doberman pinchers chained to the front bumper of the car. And that was kind of like my indoctrination into now I know why he did that now, 30 years later, right? It was for this. It was so that I could go through all those experiences and then hopefully benefit consumers.
Well, we were conversing just shortly before I started recording, and I kind of stopped you because we started going down this path, which was what I was alluding to. You have a unique passion for how auto lenders report on the credit report, and what I was asking you, why you went down this path, and you started telling me how you were bothered by. I don't know if it's the lack of education or just the industry altogether. So I wanted to ask you to speak more about that, about why credit repair and why specifically the auto lending industry.
Sure. I mean, I kind of started, I opened this place up a couple of years ago, and I started just, I think for the reasons that we all kind of start, we get really intrigued by all the mechanics of credit reporting and stuff. And I've been dealing with credit reports pretty much all my life, but for different reasons, right? I was a consumer of credit reports. So the only reason I looked at a credit report was to make an underwriting decision or something. So it fascinated me when I started looking at it from the other perspective. And then I started realizing that, man, there's a whole lot of stuff wrong with these credit reports, especially in the automotive side. When I see, you know, when I look at it a different way, I guess, when I look at it from the consumer's point of view, and I just thought this is something I could do, you know, that I feel competent at, and you know, I saw a lot of things that were wrong, and I want to make them right. That's kind of my
Right.
motto.
I feel like you have like, is there like a specific incident that kind of sticks in your head every time you start talking about this? Because you do really get very,
I get wound up.
intense.
Yeah.
You get intense, yeah. I dig it though. I dig it. I mean, if something moves you that much, and you can turn that into, you know, what gets you to bed every morning, then awesome.
Yeah, it's like it's just you know, to call something a loan that isn't a loan to me is, you know, I just see how it affects everyone. You know,
All right, I'm not gonna belabor the point because I feel like I'm beating you up on the point. I know we're gonna get into it in a bit, okay?
All right.
All right. So let's start digging into it because the people are gonna see for themselves, you know, how much knowledge you have on this topic. So,
Sure.
the first thing I wanted to start off with was the very first video you actually put out to the credit industry that I saw anyway, was auto loans versus credit sale. Even the credit bureaus don't know the difference.
Sure.
So auto loan. Again, this is from one of the papers that you had put out that I was taking notes on. But if you could maybe elaborate on this a little bit,
Sure.
auto loan direct financing.
Yeah. So basically, a loan is a money advance, and when you look at it, a loan contract, you're looking at when you see the amount financed in the you know, in all the disclosures that they're showing you, that amount financed represents the amount of money that was advanced on your behalf by the lender. And so that's what happens in a loan. You have a borrower and you have a lender, and it's a very transparent transaction. The amount financed is the amount of money that the lender is sort of putting out there on your behalf. And credit sales are different. Credit sales aren't money advances. They're an advancement of goods. And, you know, commerce has been, you know, laws of commerce have been around forever, for 6,000 years, right? And if you think about, you know, the difference between these two things is there's probably more credit sales happening than loans, or they probably started in history. They started before. You think about the history of like how people started doing business. You know, I can imagine that before anyone loaned anybody any money, there were people giving, you know, like, I'll give you this sword and you pay me, you know, like five shillings a week or something for 10 weeks, right? That's a credit sale. So it's goods for a promise to pay for those goods over time. And when you don't understand that, if you're a consumer, whether you're, you know, when you're sort of, when you're in the situation where you got this bad account, you're trying to do something about it, you're trying to protect yourself, you're trying to assert your rights. If you don't understand that concept, then, you know, you basically the first thing you should know, you don't know.
Let me see if I can break this down so that like the average person could understand a little bit. I have a banking background, so when I say the average person, I mean somebody who's not used to working with debt instruments.
Absolutely.
Right? So it's not. I mean this to sound like I'm, you know, some smart person. On the contrary, I think very average, so I can break this down so that even I can understand. Okay? The difference, I think, that what confuses people is because you're involving a car dealership. Take the car dealership out of the equation. If I'm selling my car and I sell my car to Steve next door and he's making me payments, well, that is a credit sale. Right. Whereas if Steve goes to the bank, gets a loan, and then buys that car with that loan, then that would be the auto loan.
Yep.
Auto loan, right? So that's the main difference. If we just take the car out of the car dealership out of the scenario, that will kind of illuminate what the difference between the two are. And what you're saying is that credit sales are actually much more common than the auto loan.
Correct.
Okay.
And so what happens is both the credit sale and a loan have a piece of paper. Basically they have a promise. It's a promissory note. On the loan piece of paper, you have a borrower promising to pay money back that he's borrowed. On a credit sale, you have a promise to pay for this car over time. Now, what the dealer does, and what makes it super confusing for everyone, is that the dealer now has this piece of paper with your promise on it, and he doesn't want to collect it. He's not in that business. He just wants to sell cars. So he just takes that piece of paper and he sells it and assigns it to finance companies and debt servicers that are in that business to, that's their business. They like to earn finance charges and things. So they'll bid essentially on that document from the dealer, and the dealer will decide who gets it. But the main point is that it's the dealer's decision. And in the law, in order for that to happen, the dealer is the one extending the credit.
Right.
So they're the original creditor. And this is super important if you're getting sued over an automotive debt, because as you know, proving who owns the debt, how it originated, and how it got transferred from one, creditor to the next is super important, that process. And some attorneys don't even know about this.
Okay, so let me slow it. Let me slow it down a little bit again. I know some people are raising their hands. They have questions. I am not that smart, like I was saying. I don't know how to check the chat box and keep this thing up. I was trying to do it a second ago, and I pulled up YouTube. So you got to work with me, people. So again, to illustrate the point a little bit differently, I think that to help everyone understand, same scenario. I'm selling my car. My next door neighbor, Steve, wants to buy it. If I sell him the car directly and I agree to take payments on the car, we draw up a document. Okay, that would be the note in this scenario. Okay,
it would be a retail installment contract.
A retail installment contract. Thank you. That's right. Exactly the point that you're trying to make. I just messed it up, right? So it's a retail installment contract. If I then took that retail installment contract and I sold it to some third party who professionally buys those notes, those contracts at a discount, so that they can collect on it. The problem they run into is if my next door neighbor Steve defaults on it, how that transaction is handled should be different than if he went and got a loan and he defaulted on that loan from the local credit union, for example.
Correct.
Right? Okay, cool.
Yeah, absolutely.
So what it comes down to is, what are the differences in regulations that people aren't aware of that they should be aware of? And that's what I think. Again, from another one of the pieces that of content that you put out, I made a list of. I took a list of that you put out of about, I guess, maybe 15 or 20 of the notable differences in regulation. Maybe you can go over some of them to help us understand better.
Yeah, absolutely. So, obviously, the maximum rate that the creditor is able to charge in those two scenarios, loans versus credit sales, is different. It's regulated differently. All these things are regulated by your state. So each state has there's some states that have retail installment contract acts. Okay.
And just to go not to go off on a tangent, but how would somebody find out what those regulations are for their state? Is there is it a state website? What is it called? Like what type of is it like NewYork.gov kind of thing?
The hack of doing that is just pretending like you're going to go be a car dealer, and you find the state association, you find the state auto dealer association.
Okay.
And you contact them and you say, hey, I want to be a car dealer. I want to finance some cars. How do I do that? They're going to give you some sort of package. They're going to tell you exactly where to go to find out the information.
Okay, so this is involved. This is not like something you could just Google search real quick. You're going to have to submit an application and get some documentation and pour over it.
Well, what I'm saying is they'll point you in the right direction. They'll point you to the right website for that state.
Okay.
And that's what's confusing. In Texas, we have the Office of Consumer Credit Commissioner, the OCCC. and in who regulates motor vehicle retail installment contracts. In New York, or in North Carolina, I'm sorry, the AG does that.
Okay, I see what you're saying.
So that's what I'm saying. It's like, who do you go to? I mean, you can always go to the AG. And
let them do the work for you.
And then the AG will tell you where to go to. But to me, the hack is, because I like to reverse engineer that kind of thing. I'm like, I'm just going to put myself in their shoes and then figure out what I would have to do to be compliant.
Okay.
Kind of thing.
Right. So sorry for taking you off of the original path, but I just wanted to get that for my own selfish reasons. And
then, so finance charges, bad check charges, late charges, all of them are regulated differently. Grace periods, the disclosures that are given to the customer are different. Restrictions or limitations on acceleration, or repossession sometimes, rights of rescission, rights of, rights after default. What constitutes a default is sometimes different between a loan and a credit sale.
Okay. So if I was a consumer with a repo on my credit report, actually, I think I'm jumping a little bit ahead of us. I had some more. So just before we get to that point, you just had you had listed some more noticeable differences. I don't know if there was any in particular that were more grievous than others.
Well, I'll tell you one, like the credit seller's licensing requirements. I'll tell you here in Texas, we have a really good one that helps in my business, which is that anyone that holds a retail installment contract has to have a motor vehicle retail installment contract license. And so what that means is when a third-party debt collector gets their hands on a Santander balance, they must have a motor vehicle retail installment contract license, a Texas license. And if they're from Colorado, this third-party debt collector just ran across one 4 days ago. If they're from Colorado and they just bought a bunch of debt from Santander, they're not aware that they're supposed to have this license, and they start trying to collect on this debt. It's just an automatic FDCPA, FCRA violation. They're asserting, they're trying to collect a balance that they don't have a right to collect. That's a big one, like here in Texas. That's a big example for Texas. But things like that, licensing requirements, their obligations upon default. But again, it does get, because all the states regulate it, a little bit differently. It is a matter of just trying to understand what you're looking for in that state.
Okay. If I was holding a copy of my credit report, is there anything that could help me, or what steps would I need to take in order to determine if I have a contract or a note?
Getting familiar with some of the companies, like all the big GM Financial, Ford Motor Credit, Chrysler Credit, those types of those what they call captive lenders in the automotive industry. They just purchase retail installment contracts. So all those big lenders like that, that's primarily what they do. If you bought your car at a car dealership and they did the financing and you signed a contract in the finance office there, that was most likely a credit sale. I don't really know of any states where that could possibly be a loan. It's possible that some weird state has, makes finance officers and dealerships agents of a bank or something, but I don't know of anything like that. What was the question again? I get lost.
No problem. If I was holding a copy of a credit report, is there how would I go about finding out if I had a contract?
If you bought your car at a car dealership, looking at the credit report, most of these Santander, Capital One, they're buying retail installment contracts from car dealerships. So if you bought your car at a car dealership and you negotiated your financing with them, it was a credit sale. You don't, I mean, the reports won't necessarily help you. It won't say it. They all say loans, which is my big point, is they all say that they're auto loans. That's inaccurate.
Okay.
So
again, I took one of your quotes off of one of your documents. If a consumer attempts to research laws about car loans, they may find laws that don't apply to their transaction. They may think they have rights they don't have, but they may have rights they are unaware of because they're looking at the wrong law. I think this is the heart of the matter. This is what pisses you off so much.
yeah, and it's like, I don't know if it's in the slides. Oh, that one's next.
Yeah, we're getting there.
I was going to talk about.
You want to get in it? Okay, let's get in it. Okay.
Yeah, let's get into it.
All right. So specifically, experience in the CFPB, right?
Yeah, I mean, well, everybody's guilty of it. I mean, sometimes I catch myself calling something a car loan when I know it's not a car loan. Like it's so just dominant, right? That language. But when you're trying to get something deleted from a credit report, as you know, Brian, you got to operate like within the legal fiction, right? The law. So when you call something a loan, there's a definition for what a loan is in the law, and it's not what they're talking about. When you go arrange your financing at a car dealership, that's not a loan anywhere found in any law. It is a credit sale in the law. So when you're trying to deal with this company, you basically have to catch them making factual errors, as you know.
Okay. So recently you had you started investigating the credit bureau websites, looking for specifically anything regarding auto financing. And
yeah, I was trying to figure out what are they teaching consumers about car loans and how to how they work and stuff. And really, what I just found was a bunch of it was nonsense. I mean, basically everything that they're talking about is how to get a car loan, and they're talking about loans over and over. They say loan, and and they're trying to prepare you to go to the dealership to buy a car, when probably I'm taking an educated guess here, but at the point of sale, when someone buys a car, they're usually, as far as originations of those types of debts, you're talking 70%, 80% credit sale. So they're educating consumers about this auto loan that is really rare.
Right.
It doesn't happen that much. So they talk about loans, and then they talk about them as if they're credit sales. So here, let me see what I found here. Oh, Experian is terrible. They have on their website that it says that the lender owns the car. I mean, can you imagine that? So yeah. Experian is teaching consumers that when you go to a car dealership or when you get a car loan, the lender owns the car. And that's just, it's absurd. Why would you borrow money so that someone else could own the property, right?
Well, if it was an auto loan and the car was collateral, in that scenario, if the car is collateralizing the loan, it was actual loan, like an auto loan. Right. In that scenario, if the car is the underlying collateral, in effect, if you were to default, then they can take the car from, it's my semantics. You could argue that you technically own the car until you pay it off. But what you're saying is that, since most of these transactions are not actually loans, but rather credit sales, that they have no collateralization from this point of view.
Well, you give the creditor a security interest in your personal property, so which is the car specifically. So you own the car, and as the owner of this personal property, which is a car, I'm going to give a security interest to the creditor because he's allowing me to pay this back. or pay this in payments.
Right.
But yeah, I think I don't like that, because I don't like the way they're saying that the bank owns the car, because then it makes the consumer feel like, oh, well, it's their car, it's not my car, and that's not true. It's your car. You gotta,
It's your car in the same way that if you took out a mortgage, it's your house.
Yeah, I mean, here might be an example. Like if someone calls, if someone owes a debt and is in arrears or something, and they're calling the bank to come pick up the car, and they're basically, they might say, come pick up the car. If they think that the bank owns the car, then they think that the bank is responsible to come pick that car up and to take care of it, and that's not true.
Okay.
I mean, you own the car, and you're responsible for it.
Right.
Until the, if they foreclose on it, if they take possession and control back over the car, now they're responsible for it. They got to keep insurance on it. They got to, or like the liability of that car is theirs.
Right.
Anyway, I don't know if I explained that.
You did. Anything else you want to explain on Experian, or do you want to hit CFPB?
No, let's go to CFPB. Let's check them out.
Get this out of your way. There you go. Okay. So CFPB, this is stuff that you found on their website. Some types of dealerships finance auto loans in-house to borrowers with no credit or poor credit. And your response was dealerships are not licensed to arrange or do loans. They can only do seller financing.
Yeah, so basically what I'm saying is that every, when you go to a car dealership and you do this transaction, it is an in-house deal regardless of your credit. So I personally, thank God, recently have had really great credit. So, but even if I get 2% on my car loan, on my car, see, there I go again with a loan. If I get 2% on my auto financing and I sign my document there at the dealership, doesn't matter what my credit is, it is an in-house deal.
Right.
The dealer owns it. The dealer can do whatever he wants with it.
Like you were saying before, though, unless they have a licensed banker sitting in every office, are they writing loans or are they doing seller financing?
Right. I've never, I only say that to cover myself just in case, but if you, contract law, I don't know how much you know about contract law, but in contracts, there has to be something called consideration, which is the value exchange, right? That the two parties have. And so if you think about the consideration that's happening, is you're getting a car and they're getting a promise that you're going to pay them back.
Right.
But in a loan, you're getting money and they're getting a promise that you're going to pay back the money.
There you go. That's a great way to illustrate the point. Yeah, that's a very good point. And the other one, CFPB stated the interest rate on loans from these dealerships can be much higher than loans from a bank, credit union, or any other type of lender. And your response was dealers do not charge interest because interest charges are earned on real money, advances, aka loans by lenders. I think that kind of alludes to the point you just made, that in one scenario you're borrowing money, so they're earning interest on money, whereas the other one they're getting fees for the creditor financing. Right.
And so when you see that amount financed, so what makes this also confusing, obviously, is the TILA disclosure, which is supposed to be a helpful thing, right? It's the box that tells you what your effective APR is.
TILA, for those who are not in the banking industry, it's the Truth in Lending Act.
Right. So it's supposed to, the federal government basically is saying, hey, when you charge someone costs for credit for financing something, you have to disclose it to the consumer in this uniform way. And so when you look at an auto loan document, you see a TILA disclosure, and then when you look at a credit sale, you see a TILA disclosure. So they look the same, and that's what makes it confusing. But if you look closely enough, you'll see that in the loan document it talks about interest charges, and in the credit sale document it talks about finance charges.
Mm-hmm.
And that's a distinction in, what those two things are in the law. They're different.
Right. So if I'm doing a credit sale, I'm earning finance charges, whereas if I'm an actual lender, I get interest rate. It's like
Right.
if I'm a mortgage broker or a mortgage banker. If I'm brokering a mortgage, I can earn points on it, but if I'm a banker, I can sell a higher rate and earn that. That
Right.
pretty much sum it up. Okay, cool.
Yeah.
All right. So you gave us one really good one earlier. What are some of the other common violations that you see on credit report? How you catching these guys?
Yeah. One good one is terms. So when usually there's pretty standard terms on auto financing. There's 60 months, 66, 72, those year and half year marks. I'm starting to see some 75-month terms, but when you're looking for inaccuracies, FCRA violations, terms is one that I find all the time, where someone financed a car for 60 months, but the term says it was 62 months. And a lot of times what happens in those is what the defense is from the data furnisher, the creditor's point of view. They'll say that they gave you a deferment, or that you agreed to some sort of a deferment.
Okay.
And that's why they extended the term. But unless they got it in writing, then the deferment doesn't hold water. And also, sorry, I get this thing keep popping up on my computer. Unless they got an agreement in writing and they gave you disclosures, TILA disclosures about the costs of what the deferment is, if that's what they're doing, a deferment is basically you're pushing a payment to the maturity date. So you're not actually adding 30 days to your financing. In other words, they're not extending the term when they give you a deferment.
Becomes more of a balloon payment.
So it basically just pushes to the end. So now instead of having one payment due, you're going to owe two. The reason this is never an issue is because a lot of times you don't get to the end. You trade your car in or whatever. So no one ever, it never becomes an issue. But yeah, I focus in on those. Those are the ones that you can see kind of plainly, and some of them are just computer glitches, I guess, or, data, these companies trying to communicate with each other. I'll see them with 101 months, or some crazy term in there. Also balances, if you look at the balance across the three bureaus, if you're looking, you'll see differences in the balances that are owed. You could also payments, like if your car was charged off or repossessed and they show a payment, you can't have a payment on an accelerated note.
Okay.
So the payment should be zero. So if you see a charged off balance on your credit report and it shows a payment, that's inaccurate, and it could actually hurt you when you're applying for a mortgage. You know a lot about mortgages, but if they're showing a payment in there, that could get picked up in a
debt to income ratio.
In the debt to income ratio in an underwriting process, and you could just get turned down.
Sure, so killing your credit score.
Yeah, that's one of my first clients had that issue, and 2 years ago, and it was that exact thing where they're showing a payment, they're budgeting him for it, he can't get a house. Luckily we prevailed on that one, got him a little money. But that's one that you see all the time. Sometimes they correct it, sometimes they don't. But,
any other good ones?
I'm trying to think. There's really specific ones that are per the bureau or specific to the bureau. Experian seems to have a problem with status dates. I don't know if you've seen that, come across that. but they update the status date on the account
Okay.
incorrectly. And that affects your scores when they make it more recent, basically, than it, it looks like the activity is more recent than it is.
So you're saying most of the violations you're finding are actually a result of your clients handing you credit bureau updates in response to your dispute?
Yeah, I mean, a lot of them. That's where you find them. I just had this conversation today with someone that, I'm trying to get. I know I have something, but I have to have the word from the horse's mouth. I have to have the proof from the bureaus
Sure,
that
sure.
they're reporting this wrong. I can't count on the reseller of the data, which is, I use Identity IQ. I can't count on that to verify that this is wrong. I have to get the bureau response.
Right. I had an epic rant this week because just last week I was speaking with an attorney who specializes in FDCPA violations.
Mm-hmm.
And what it comes down to is if you don't have the responses, the updates from the bureaus, can't help you. Another one, I don't know if you know about, Danny Zem is putting together a class action against Verizon. What is the requirement? What is the class action? Because Verizon is updating the date of last activity with each dispute. So if you don't have an update from the credit bureau, can't help you. So I went to my database, I have 46 or something people with Verizon accounts on there. Of them, how many have actually sent me back any kind of credit updates? 2.
Right.
Oh, shit.
No, I mean, absolutely. It's, I wish there was an easier way. It seems like, the system is sort of set up to make it harder, but if you can push through it, you're going to succeed.
Well, it's not the system. It's, sometimes people they don't hold on to the mail, or if they hire somebody, they just kind of, throw it on their shoulders and they don't have to do anything. Doesn't matter. Boys and girls, let this be a lesson. If you're not holding on to your updates, you're wasting your time. Can't help you.
Yeah, there's only so far that you can get in the process.
Yeah, you're just disputing blindly with like template generic letters if you don't actually have stuff and you can't cite violations and back it up with proof.
Sure, you're guessing. Yeah, I mean, trying to take educated guesses, but you can't. But yeah, we know that if we had it, we would find it. We could do something about it if we have the stuff straight from the source, for sure.
Okay. Any other ones you want to throw out there before we start taking some questions?
No, I think that's.
Okay.
Trying to think of another one. It's more common. What was the other one I was talking about? I mean, the other one's a little complex, but it's about strict foreclosures. Do you have strict foreclosures in mortgage? Are you familiar with that term?
Not strict foreclosure, just foreclosure.
Okay. So a strict foreclosure in auto is where the creditor essentially waives he constructs a waiver of debt through his actions. It's called strict foreclosure. This is found in UCC. All of the states have adopted the UCC, Uniform Commercial Code. And, in many cases, if the creditor hasn't gone through the right steps, they've basically constructed a strict foreclosure, which means they should waive the balance.
Okay.
And so they, in their attempts to collect the balance that they should have waived, it can create issues for them. That one's a little, it's a little bit more involved, but
they're gonna need help with that one.
Yeah.
Don't try to pull that one off without help.
Yes, sir.
All right, so let's take on some questions. They're already starting to come in. All right, Salim asks, the title to the vehicle is pledged as a surety bond on the borrower's performance to the terms of the loan. The MV1 makes this possible as it is actually a limited power of attorney form. You want to take that one on?
He's going to have to explain that question to me. I mean, as a surety bond.
Actually, he posted like maybe 5 beneath it. Hold on a second. The true title never leaves the county courthouse even after the terms of the loan have been met. Certificate of title is not the title, rather proof that a true title exists.
Is that a question or is that a statement?
No, yeah, just making a statement. Experian immediately downloads over 1 million vehicle accounts monthly without verifying anything. Okay. And He's just participating,
Yeah.
Salim. Right on. All right.
Yeah.
So yeah, Salim appreciates the all the information. If anybody
Awesome.
else has any questions, you can throw it in the Q&A box. That's the easiest way for us to do it, so that we can track on the video who, you know, what was covered during what time. All right, so Salim actually has a question on this one. Oh shit, what did I just do? What about the certified letter the borrower is to receive after the repo specifying the terms to redeem the loan?
So I think what he's talking about is there's two things that a creditor can do once they have control over the car, once they repossess it, and they have, you know, and they have two paths basically that they can choose. They can choose to do what's called an agreement to accept collateral and full satisfaction of the debt, which is a strict foreclosure basically, or they can try to sell the car and collect the deficiency balance. And so in the latter case, which is what most of the big lenders do, they will send you a letter, and he says it has to be certified. It doesn't necessarily have to be certified. The law doesn't say that it has to be certified, but you know, when I was a creditor, I certified them all because I just like to have the certification of the file. But and I was smaller, so the big ones aren't going to certify the mail that they send, the big lenders, but they're supposed to send you a letter saying, this is what we plan to do with the car. It's known as a 10-day notice of sale. It says, you know, we're going to sell this car in 10 days. And then whatever, and they have to tell you what the balances are and all that kind of stuff. And then they have to send you another letter after they sell the car called a calculation of deficiency or surplus, which explains, you know, whether you have money that is left over and owed, or whether you have a surplus, which means you'd have equity in the car and they owe you money for, you know, for equity. Okay. Which is rare, but usually they would send you a letter that says you owe money. And I think that's what he's talking about. It has to be done within a certain time frame. Some of the language in the UCC leaves it, you know, it doesn't specify exactly how many days, but, you know, within a reasonable amount of time.
Right.
So they have to sell the car within a reasonable amount of time so that it doesn't depreciate, you know, excessively. So that they have to have what's called a commercial reasonable sale of the collateral, so that you're not left with a huge deficiency balance that's sort of unfair. And so I think that's what he's talking about.
Yeah, he said correct underneath that. I guess he was just looking for confirmation.
But that is a great thing to get if you're trying to get a repo removed from a credit report. I try to get the calculation of deficiency letter because I see errors in them all the time. And the errors that I see are usually they're basically attempting to collect more than they're owed. So, and I don't know why this happens, but it does happen, is that calculation deficiency letter goes out and it basically says you owe $12,000 on the deficiency, but in reality you owe $9,000. And when you pull your credit report, it'll say you owe $9,000. And so it's really confusing. But that notice that was sent to you saying you owe $12,000, that is, you know, that's basically an attempt to collect the wrong amount, you know,
right? Which
doesn't necessarily damage you, but it definitely could be something to pursue them over and to talk to regulators about, to leverage to get an item removed from a credit report. And I see it a lot.
Okay.
So it's a great asset if you're trying to get a repo removed from a credit report, to get that letter.
I would love it if you come out with like a timeline about how someone goes into default and the legal requirements that the lender or the creditor is required to take
Sure.
as the repo process goes on. I would totally buy that. CJ asks,
I need ideas. I need.
oh man, I got ideas. Oh, hang out with me, man. You'll have no problem whatsoever. I keep a notebook next to my bed because this just doesn't stop. As you can see, like, listening to the two of us talk is hysterical. To me, it's like I'm tequila and like your gin. You know, I'm I'm like listening to the two of us talk. I'm at 100 miles per hour, and you just like kick back. Hey. CJ wants to know what can. Yeah, I love it. What can you do about a redeemed repossession on your credit report? CJ's asking.
Redeemed repossession. So
besides hiring Ken.
So I guess was a repossession redeemed? I mean, you know, one is that accurate? Because I have seen where someone where I've worked on a file where it wasn't it was never repossessed. The car was never repossessed, but it says that it was a redeemed repossession. I'm not sure if that's what he's talking about, or if you're saying, but if there's anything unique to that.
I guess he's asking like, what would be the steps you would take, like maybe a general outline of the procedure you would take in order to address a redeemed repossession on the credit report. What would be like if you're looking at the initial credit report? What are you looking for, if anything, and then what steps would you take, and what would you be looking for along the way? Just kind of an overall summary. I'm not expecting to. Yeah,
sure. I mean, one is I would compare it to the all the bureaus to see if they're reporting it the same way. If one says that it's just a repossession and the other one says it's a redeemed repossession, then there could be something to
dig deeper
for. There, someone's wrong, or it should be more accurate on one of the bureaus if that's true. I mean, to be honest, that particular situation, I mean, so it says redeemed repossession, that's the status of the account, right? I mean, when a repossession occurs, things have to, there's things that have to happen. The note had to be accelerated.
So is there a payment? If it was accelerated, was there a payment, right? And in that particular situation, you see if there's a payment amount on there, then that would be a violation you could pursue, right?
Absolutely.
Would you dispute right away, or would you go after the creditor first? Would you request documentation?
I always go for the bureaus first, just because I think they're less. Well,
they're lucky too.
But they're also less. I don't know. They're less organized. They're less informed. They're a mess. They're too big to function. You're heard of companies that are too big to fail. The bureaus are too big to function.
All right. So you would dispute, and then you would request documentation from the creditor, assuming there's no, if you have any obvious violations, you would go after that. If not, then when you get the documentation back, what are you looking for? If it's a note or a credit sale? Here's what I would
look for. I really do focus on that. But,
I know you do. I'm trying to drag it out of you.
But like on a redeemed repossession, I would ask for the backup paperwork that's involved in a repossession. Like, give me the repossession order. Give me the give me the notice of acceleration. Give me these types of things. If you put pressure on them when you ask for all the backup, the data furnisher sometimes will just correct it.
Okay.
Or make it a better rating. Instead of saying redeemed repo, it's just current now.
Right.
That's the other thing. Like, what's the status now? Is this like an old account that's already paid off and done? Or is this a current account that you're paying on and it says redeemed repossession?
Right.
It's almost, the fact that it's a redeemed repossession, if you're currently making payments on something, it's obsolete,
Right. So
why would it matter if it's a redeemed repossession? It doesn't. really.
For the uninitiated, Ken used the word there that you might not be familiar with, data furnisher. A data furnisher is the company reporting to the credit bureau. So that could be a collection agency, it could be the creditor, anybody who's reporting that data to the credit bureaus. So what Ken is saying is, well, the data furnisher might correct it themselves if you start asking for documentation.
Yeah, and you could ask them for lots and lots of stuff. That's another thing, is that the states, again, are going to regulate how long they're supposed to have these records on file. And it, again, unique to credit sales and loans. And, usually it's just related to the last activity on the account, how long they're supposed to have it. And it's not necessarily 7 years, but it is for quite a while. So you can get your hands on this stuff.
Okay. CJ said they picked up the car, he got it back the same day. It was their mistake, but it was a current account. He was trying to get a new car and it came up. So just for his own edification, if it shouldn't happen again. Awesome.
Well, if it was their mistake, that's a big problem, even if it's true, right?
Right. So Thomas asks, if a borrower does a voluntary repo and there's a balance remaining, is it best to try to get to go after a deletion while it's with the original creditor, or wait until the debt is sold to an outside collector?
I always find the third party debt collector is a little easier, but yeah, it depends on your goals and your timeline, I guess. I would definitely go after. I'd go after it now.
Yeah, I would probably go out because you got to get the original creditor anyway. So now you have both of them on the credit report, which is not helping your situation. I would go personally. I'd go after the creditor directly, and look, cancel your insurance right away. They need to refund you that balance. If not, it's credited towards your balance, and you have something to go after. And the fact that they are reporting an incorrect balance because you terminated your insurance, and that amount has to be adjusted in your overall balance. Derek told me that one.
Yeah, the refunds on all the unearned products.
Yeah. So if you can prove that the balance is wrong, with like case in point with insurance, then you have a valid dispute to go after.
I got an idea about that one, but I don't know about it. Basically what that means is that their computer system, once the loan's charged off, once they've basically closed it, they don't adjust their balances anymore. Okay. Even if they receive a refund.
So the chance of them reporting inaccurate is like 100%.
Yeah, if they have that issue within internally, and I can tell you this because I had to deal with the software that services automotive debt. Once you charge the thing off, you basically don't, you stop reporting it. You can't update the bureau information unless some new, unless you revive the account somehow.
There you go, boys and girls. You just learned a new trick.
It's just a again, a lot of this stuff is software trying to communicate with each other, and all these, I guess the conversion of the data back and forth sometimes has problems. And that would be an example of one, because they should update the balance if they got a refund on something.
Right.
But they just can't. The computer won't let them.
Salim has another question. I guess he had a client with a car in a dealership for repairs. The mechanics ultimately totaled the vehicle while running a red light. The creditor or lender was NMAC, listed the vehicle as a repo, and then the borrower's insurance company wanted the borrower to file a claim. His question is, isn't the shop responsible for the vehicle and the loan insurance claim? It's kind of like a legal question.
Oh, absolutely. I'm not an attornay, but they have to have garage liability insurance.
Yeah, we go after the credit report. The attorney would need to handle who's responsible. How it's reporting on the credit report, well, and obviously that's something you could go after. It's reporting as a repo. How would you handle that if there's, from a credit report point of view, though, if an auto loan is showing as a repo, and it was in an auto accident, that no fault of the consumer.
Right. The thing is that they do what's called a paper repo, which is, if your car gets totaled, right, you still have to make your payments, until the matter is settled, right? Mm-hmm. So and there's a time there where you have to file a claim, and they go, and you might argue with the insurance company, but meanwhile you pretty much have to stay current on the account, right? You're obligated to do that. And if you fall behind and don't make your payments, then they're basically going to do what's called a paper repo. They're going to say, we're foreclosing on this, we're accelerating it, the consumer's defaulted. So
Okay.
they're basically, even though they didn't actually go hook up the car in the middle of the night or whatever, they're constructively repossessing the car.
So for all intent and purpose, you're going to handle it like a regular repo and tell them to go get an attorney.
Yeah.
Cool. All right, Ken, speak with us today.
Hey, thank you, man. It was a pleasure. I was a little nervous because this is my first, webinar, but I really appreciate you and all the people that are paying attention and listening to me, sir.
Awesome, man. Have an awesome night, and I hope we can get you on the show again. If you put together a course, let me know, because I'm going to promote the heck out of it, and I'm the first in line to buy it.
Awesome. Thank you.
Thanks, man.
Take care, bro.